Barriers to entry and exit. Barrier to entry is any obstacle that prevents a new firm from entering the market, and barrier to exit is any obstacle that prevents firms from leaving a market. There are four kinds of barriers to entry. Legal barriers, they are imposed by the government. For example, patents, licenses, red tape. Red tape means excessive bureaucracy. Standards and regulation, insurance regulations. Technical barriers are industry specific. Startup costs are industry specific. Sunk costs are the costs that a business will not get back when they close down. For example, they might have invested in training of people, that is a sunk cost. Economies of scale, if there are economies of scale that one firm is enjoying, barriers to entry will be high for other firms. And a natural monopoly. Natural monopoly, we have just now seen, that is an industry or a sector with high barriers to entry, high startup costs that prevent rivals from competing. An example is an airline and railway. Strategic barriers, they are imposed by the competing firms. Not exactly imposed. The firms operating in a certain market structure experience these kind of barriers from competing firms. That can be predatory prices, which is a large scale undercutting prices. Limit pricing, which are prices that are set at a very low level with which other firms cannot compete. This can happen in an oligopoly, and predatory pricing can also happen in an oligopoly. And heavy advertisement to build a strong brand. Then brand loyalty. Brand loyalty is one factor which enables firms to retain and increase their market share, also charge a price of their choice. If a lot of customers are loyal to one brand, it would be very difficult for other firms to snatch their market share from them. Barriers to exit are undervaluation of assets. If the assets in which a company invested, while exiting they want to sell it and they get very low price, this becomes a barrier to exit. Redundancy costs, when you are firing people and when you are telling people, getting rid of people, those costs may be extremely high. Penalties for leaving contracts early, this is a major barrier for exit. And the last one is sunk cost. Now let's move to contestable markets. A market is perfectly contestable where there is a pool of potential entrants seeking to enter the market because entry and exit are costless. This makes prices very competitive because new firms can easily enter the market. All firms are subject to the same kind of regulation and state of technology. Mechanisms are in place to prohibit limit pricing as existing firms have lower cost than potential entrants. If prices are set very low by the new entrants, the old firms may be thrown out of the market, which will create inefficiencies because the firms already operating in the market have lower costs and they will be operating at allocative as well as productive efficiency. If new firms enter the market with limit pricing whereas their costs are high, there will be no productive efficiency for those firms. Firms already in the market are vulnerable to hit and run competition, which makes them keep their prices low, and they constantly have a threat and fear of new entrants, due to which they try to keep the prices low as well as keep their costs down in the long run. How can the market structures meet the requirements of contestability? Monopolistic competition has few barriers to entry due to non-price competition. It takes small firms time to build up a customer base to obtain brand loyalty. In this type of market, there are barriers to entry in the form of licensing and regulatory requirements. This firm fulfills the requirement of low or few barriers to entry, and that is one of the characteristic of contestability. Oligopoly does not fulfill requirements of contestability as such, and monopoly in its pure form is not contestable. However, if it's possible for any new firm to enter a monopoly market, then contestability can be achieved. The concept of contestability is basically to make the market prices competitive and to benefit not only the customers but also the firms through efficiencies. If the firms try to operate efficiently, keep their costs down, and do not waste resources, allocate resources efficiently, then obviously it's going to be a win-win situation for the firm as well as consumers. Also, contestability is a concept that favors prevailing normal profit in the markets, and it discourages existence of supernormal profit in any market, because supernormal profit is exploitation. Secondly, that structure does not have any efficiencies. Similarly, oligopoly does not have efficiencies. The only kind of market structure which has efficiencies is perfect competition, and in perfect competition, in presence of normal profit, it can be a win-win situation for consumers as well as businesses. Contestability basically depends on the cost of entry and exit into the market. Taking this condition into account, we can say that in theory, only a perfectly competitive market is most similar to a perfectly contestable market, because barriers to entry and exit are low. Just as in any contestable market, only normal profits are present in the long run. Prices cannot be set below average cost to deter new entrants. Allocative efficiency and productive efficiency is achieved only in perfectly competitive market as stated earlier, and the number of firms in the market does not matter in terms of revenue, in terms of provision of goods and services to people, as none of them is affecting the market prices. Let's have a look at the graph. Effect of new entrants in the monopoly. This graph shows the profit for a monopolist. The monopolist is operating at this level of output and selling at this price, where it is earning a supernormal profit of this shaded box. If there is a threat of new entrant, the monopolist will be forced to produce the same output at a lower price, and when they lower the price to this level, which is P1, producing the same output, volume of sales will increase and the profits will change from supernormal profits to only normal profits. However, inefficiency will still exist in the market, because the price that the monopolist will set even after reducing the cost is not on the point where the average total cost is the lowest. To sum it up, a monopoly will shift to normal profits if there is a threat of new entrant, which is not very practical. A monopoly is a monopoly for a reason. However, there are chances of new entrants if they enter with a very foolproof strategy and a solid plan to break the old monopoly and become the monopolist themselves. When the new entrant becomes the monopolist, that new entrant is also going to want to charge supernormal profits. But why anybody would want to enter a monopoly? They would want to enter a monopoly because of presence of supernormal profits. Supernormal profits are a signal for all kinds of firms in all kinds of markets. Just keep in mind that a supernormal profit cannot exist in perfect competition, but in other markets where it can exist, it is a signal for other firms to enter the market to bring the profits down and grab their share of profit from those supernormal profits. If other firms keep entering, the levels of profits, they come down automatically on autopilot mode to the normal profit level.